Hello friends, as discussed in the last unit about financial services, hereby we are going to discuss one of the fund-based services, that is leasing. Under this unit we will discuss about the leasing, parties involved in the lease contract, evaluation of lease transaction, types of leases and hire purchase versus leasing. So first coming to the concept of leasing. Leasing is a leasing is a contractual agreement or transaction in which the owner of an asset or equipment, known as lessor, provides the asset for use to another or transfers the right to use the asset to the user, known as lessee, for an agreed period of time in return for periodic payment, known as rentals. At the end of the lease period, the asset reverts back to the owner. So in leasing, there are two parties involved. The owner, first is the owner known as lessor, and the user, second is the user known as lessee. The lessor is the person who owns the asset and gives it on lease, whereas lessee takes the asset on lease and uses it for a period of the lease. Leasing essentially involves the divorce of ownership from the economic use of an equipment or asset. Further, lease can be classified into various types on the basis of different aspects. First category is finance and operating lease. Second is direct lease and sales and leaseback lease. Third is single investor and leveraged lease. Fourth classification is on the basis of domestic lease and international lease, which can be further classified as cross-border or and import lease. So we will discuss these types of leases one by one. First one is your finance and operating lease. Finance lease and operating lease are two different types of leases used in the context of accounting and finance to facilitate the leasing of assets such as equipment, vehicles or property. These leases differ in terms of their accounting treatment, nature of lease agreement and the financial implications for both the lessor and the lessee. Finance lease, also known as capital lease, is a type of lease where the lessee effectively assumes the risk and rewards of the ownership of the leased asset. In finance lease, the lessee is typically responsible for the maintenance, insurance and other costs associated with the asset, similar to how an owner would handle these responsibilities. So when we talk of finance lease, key characteristics of finance lease include that at the end of the lease term, the lessee usually has the option to purchase the asset at a predetermined price. Therefore, ownership of the asset is effectively transferred to the lessee over the course of the lease, over the course of the financial lease. Also, in terms of accounting treatment, under finance lease, accounting rules such as outlined in International Financial Reporting Standards IFRS 16, the lessee records the leased asset on their balance sheet as a non-current asset and recognizes a corresponding liability for the present value of future lease payments. In terms of depreciation and interest, the lessee recognizes both the depreciation expense and interest expense of the life of the lease. Depreciation reflects the decrease in the value of the asset over time, and interest expense is related to the cost of financing the lease liability. Further, in terms of financial reporting, the finance leased asset value is reflected on the lessee balance sheet along with the associated liability. This can impact financial ratios and key financial metrics of the lessee. So, this was about the financial lease. Coming to the discussion of operating lease in contrast to the financial lease. Operating lease is a lease arrangement in which lessee does not assume the risk and rewards of the ownership of the leased asset. Instead, The lessor or the party who is leasing out the asset remains responsible for maintenance, insurance and other costs related to the asset. In terms of ownership and return in case of operating lease, at the end of the lease term, the lessee typically has the option to return the asset to the lessor, or renew the lease, or purchase the asset at its fair market value. The lessee don't usually have a purchase option at a significantly reduced price as in case of finance lease. In terms of accounting treatment, traditionally, operating leases allowed lessees to keep the leased assets off their balance sheets. Instead of recognizing the leased asset and liability, only lease payments were expensed on the income statement. In case of operating lease, the lessee recognizes lease payment as operating expense on the income statement over the lease term. In terms of financial reporting also, operating lease obligations were disclosed in the footnotes of financial statements rather than being recorded as liabilities on the balance sheet as in case of financial lease. This approach could lead to understating the lessee's total obligations. Thus, we can see that financial lease and operating lease differs in terms of various points and accounting standards. We see that your introduction of IFRS 16 and similar changes in other accounting frameworks have led to greater recognition of lease liabilities on the balance sheet for both finance and operating lease. These changes aim to provide a clearer representation of companies' financial positions and obligations related to leasing activities. The next category, that is your direct lease and sales and leaseback sales. Direct lease and sale and leaseback lease are two specific variations of lease arrangements that companies and individuals use to acquire or dispose of assets while maintaining usage rights. Each type of lease has its unique features and financial implications. So, coming to the direct lease, it is defined as a finance lease or capital lease in which a straightforward lease arrangement where a lessee directly leases an asset from the lessor. In direct lease, the lessee assumes many of the responsibilities associated with the ownership, similar to the characteristics of the finance lease mentioned in the previous response. Key characteristics of a direct lease are: first one is in terms of ownership transfer. The lessee may have option to purchase the asset at the end of the lease term, and the ownership of the asset can be transferred to the lessee based on the terms of the agreement. If we talk in terms of accounting treatment, it is similar to the finance lease where a direct lease often requires the lessee to recognize both the leased asset and corresponding liability on their balance sheet. Depreciation and interest expense are recognized over the lease term. In terms of maintenance and cost, the lessee is typically responsible for maintaining the leased asset and covering associated costs, including insurance and repairs. When we talk of financial reporting, the leased asset value and the associated lease liabilities are reflected on the lessee's balance sheet, impacting financial ratios and metrics. Now coming to the sales and leaseback lease, we talk of the sales and leaseback lease in context of that a sales and leaseback arrangement involves a company selling an assets it owns to a third party and then immediately leasing back the same asset from the buyer. This transaction allows the company to generate cash by selling the asset while still retaining its use through the lease agreement. Sale and leaseback transactions are commonly used for real estate properties, but they can also involve other assets like equipment or vehicles. Key characteristics of A sale and leaseback agreement is that company selling the asset receives cash from the buyer in exchange for transferring ownership of the asset. Simultaneously with the sale, the company enters into a lease agreement with the buyer to continue using the asset. This leaseback arrangement allows the company to maintain operational use of the asset. Further, sales and leaseback transactions provide companies with an opportunity to unlock capital tied up in assets and redirect it toward other business needs. If we talk of in terms of accounting implications, depending on the specific terms and nature of the leaseback, the accounting treatment can vary in case of sales and leaseback agreement. Under certain circumstances, the transaction might be classified as an operating lease, or it might meet the criteria for finance lease accounting. The lease responsibilities regarding maintenance, insurance and other costs depends on terms negotiated in the leaseback agreement in case of sales and leaseback agreement. So both direct leasing and sales and leaseback arrangements offer financial flexibility and advantages to companies depending on their specific needs and circumstances. However, the appropriate choice between these lease types depends upon factors such as financial goals, accounting considerations, tax implications, and the nature of assets involved. Now coming to the third category of lease, that is your single investor lease and leveraged lease. These two are distinct types of lease arrangements used in the world of finance and leasing. These lease structures vary in terms of their complexity, involvement of multiple parties and financial implications. So coming to the single investor lease, a single investor lease, also known as direct lease or non-recourse lease, is a lease arrangement involving a lessee and single lessor where the lessor provides the financing for the asset being leased. In this type of lease, the lessor owns the asset and leases it to the lessee, while the lessee gains access to and usage of the asset without having to purchase it outright. So, in case of single investor lease, there is only one lessor involved, typically an external financial institution or a specialized leasing company. The lessor provides funding to acquire the asset and lessee makes lease payments to the lessor in exchange for the use of the asset. In terms of ownership, the lessor retains ownership of the asset throughout the lease term. However, the lessor usually assumes many of the responsibilities associated with the ownership such as maintenance and insurance. When we talk of accounting treatment, depending on the specific terms and conditions of the lease, the lessee might account for the lease as an operating lease or a finance lease based on applicable accounting standards. In single investor lease, the lessee generally benefits from using the asset without the upfront cost of ownership, and the lessor assumes the risk associated with the asset's ownership. Now, in contrast to it, when we discuss of leveraged lease, it is known as third party lease, which involves three main parties: the lessee, the lessor who is the equity investor, and a lender, usually a financial institution. Unlike a single investor lease, a leveraged lease includes an external lender who provides financing to the lessor, which in turn invests in its equity in the lease agreement. This type of lease allows the lessor to leverage their equity investment to acquire the asset. If we talk of the key characteristics of the leveraged lease, there are multiple parties. A leveraged lease involves the lessee, lessor, and the lender who provides debt financing to the lessor. Further, the lessor invests a portion of required capital or equity and secures the rest of the funds debt from the external lender, that is the third party. The lender's debt financing is secured by a lease payment and the assets being leased. Further, the risk in case of leveraged lease is shared among the equity investor, the lender, and the lessee. The lender has a claim on the lease payments and the asset, while the equity investor takes on the residual risk. When we talk of ownership and control in case of leveraged lease, the lessor typically owns the asset and enters into a lease agreement with the lessee. The lessee manages the arrangement, including coordinating lease payments and other related activities. In terms of tax benefits, leveraged lease can offer tax benefits to the lessor and the lessee, which can make the lease arrangement financially attractive. Both single investor lease and leveraged lease provide alternative ways for companies to acquire and use assets without the upfront cost of ownership. The choice between these lease structures depend upon the factors such as financial goals of the party involved, availability of capital, tax consideration, and the risk appetite of the lessor and the lessee. Now coming to the next category, that is your domestic lease and international lease, which can be also classified as cross-border and import lease. These terms are used to differentiate between the lease arrangements that occur within a country's border and those that involve parties from different countries. These distinctions are important due to the potential variations in the legal, regulatory, and economic factors across different jurisdictions. Let's explore each of these lease types. So first is domestic lease. A domestic lease refers to the lease agreement that takes place between parties within the same country. In this context, both the lessor, the entity or individual leasing out the asset, and the lessee, the person or entity who is leasing the asset, are located within the same country. The terms, conditions, and legal framework for domestic leases are typically governed by the laws and regulations of that specific country. So, we can discuss domestic lease on various aspects. Those are legal framework, currency, regulation and taxation, language and communication part. So when we talk of domestic leases, they are subject to the laws and regulations of the country in which lease agreement is executed. These laws govern the rights, responsibilities and obligations of both the lessor and lessee. The currency used for lease payments and other financial aspects of the agreement is the local currency of the country. Tax implications, reporting requirements and regulations related to the lease are based on the domestic tax laws and regulatory environment. The language and communication part, basically the contracts and communication related to these agreements are domestic agreements. Domestic lease agreements are typically conducted in the local language and parties may have a better understanding of the local business practices. Now coming to the international lease. An international lease involves lease transactions between parties located in different countries. These leases may be very complex due to the differences in the legal systems, regulatory environments, currencies, and cultural considerations between the lessors and the lessee countries. International leases are often subject to international trade laws and conventions. So, coming to the key aspects of international lease. International lease requires consideration of legal, regulatory, and cultural differences between the parties' respective countries. Parties need to be aware of potential challenges related to legal enforceability, language barriers, and currency fluctuations. International leases often involve lease payments and other financial transactions in different countries, in different currencies of the countries, which can introduce foreign exchange risk. Currency exchange rate can impact the overall financial performance of the lease. To facilitate international leasing transactions, parties may choose to follow international conventions or model contracts that provide a common framework for lease agreements. International lease transactions can be influenced by bilateral tax treaties between the countries involved. These treaties might affect tax withholding, double taxation avoidance, and tax liability allocation. Parties involved in the international leases must consider cultural differences, communication norms, and business practices to foster a productive and respectful relationship. Disputes arising from international leases may require resolution in the international arbitration or through other means, considering the complexities of the applying the laws of different countries. Thus, living international leases requires a deep understanding of legal, financial, and cultural aspects specific to the countries involved. Parties often seek legal advices and engage in thorough due diligence to ensure compliance with applicable laws and to minimize potential risk associated with the cross-border transactions. Thus, these were the various categories which we have discussed, and each categories have their own positive and negative points. So, any party who is entering into the leasing contract, they need to focus on, or they need to see on which kind of agreement they need to enter as per their specific objectives and requirements. Now coming to the perspective of evaluating a lease transaction. So as I discussed in the last slides also, depending upon the objectives of the lessor and the lessee, it is basically decided on what kind of agreement they will enter on. So a certain process or certain steps are to be followed whenever two parties are entering into a lease transaction or lease agreement. First thing is that they need to identify the objectives. They need to define the purpose of the lease transaction. Are you seeking to acquire an asset without large upfront payment? That is your lessee's perspective, or to generate income from an asset you own, lessor's perspective. So one need to identify the objective or purpose of the lease transaction. Second, you conduct a complete comprehensive financial analysis to understand the cost and benefits of the particular lease agreement. That is, you need to calculate the total lease payments over the lease term. You need to compare the total cost of leasing with the cost of purchasing and owning the asset. You also need to find out the tax implications in terms of tax advantages or disadvantages of the leasing compared to the outright purchase option. Further, understanding the impact of the lease agreement on the lessee's financial statement, considering the various aspects such as depreciation and interest, and also the type of lease they are entering into. Thus, one need to do a thorough financial analysis of the project, thorough financial analysis of the contract or the agreement they are going to enter. Third is that whenever you are looking for a lease transaction, whenever any party is looking for a lease transaction, they need to evaluate the risk associated with the lease transaction. That is, one is need to assess the credit worthiness of the lessor or lessee, or considering the condition and maintenance requirement of the leased asset. Further, they also need to evaluate the risk of changes in the market conditions affecting the asset value when they are going for the lease option. Fourth point that need to be focused on while evaluating a lease transaction is strategic considerations. One need to align the lease decision with your broader strategic goals, whether the agreement consider the flexibility to upgrade, return, or purchase the asset at the end of the lease contract, or whether your leased contract supports your business objectives and operations or not in the long term as well as the short term. The next thing which is required to be focused on is comparison with other alternatives available to the party is involved in the lease agreement. You need to compare the lease option with alternative methods of acquiring the asset, that is your purchase, outright purchase or loan financing. You need to evaluate the pros and cons of purchasing the asset outright versus lease contract, as well as you need to assess the cost and benefits of financing the asset through a loan in comparison to your lease agreement. And then accordingly you need to take the decision to enter into the specific lease contract or not. Further, you need to evaluate is qualitative factors. Qualitative factors might consist of that how the leased asset meets your operational needs, whether the lessor provides you the maintenance services or the support, and whether these lease decisions align with your long-term business goals. So you need to consider qualitative aspects so that you can take an effective decision in terms of lease contract. Further, you need to focus on negotiation and terms but with the other party. Negotiate favorable lease terms and conditions, including lease duration, payment schedule, renewal options, and any additional services or benefits while entering into a lease agreement. You need to seek professional advice also from financial advisors, accountants, and legal experts who specialize in the area of leasing and finance. Before entering into the lease agreement, you need to carefully review the lease agreement to understand your rights, responsibilities, and potential penalties with respect to that particular agreement. Based on above all the criteria, you need to evaluate and make an informed decision on whether to proceed with the lease transactions, negotiate modifications, or explore alternative options. Thus, we can say that lease evaluation is not a one-size-fits-all process. Factors such as type of assets, industry norms, economic conditions, and your organization's unique circumstances will influence the evaluation process. Thus, a thorough analysis and consideration of both quantitative and qualitative factors helps one to ensure that lease transactions whether align with their financial and operational goals or not. So, this was all about leasing, and now we will discuss the difference between hire purchasing versus leasing. Before coming to the difference between hire purchase and leasing, we need to know about the concept of hire purchase. Hire purchase is the mode of financing the price of goods to be sold on a future date. It is an arrangement relating to be sold on a future date. It is an agreement relating to a transaction in which goods are let on hire. The purchase price is to be paid in installments, and the hirer is allowed the option to purchase the goods paying all the installments. So the option to purchase the good or asset is allowed in the very beginning. It can be exercised only at the end of the agreement. So now coming to the difference of hire purchase versus leasing. See, leasing is a business deal in which one party buys the asset and grants the other party to use it in return for lease rentals. Whereas an arrangement to finance the use of the asset in which one party pays consideration to the other party in periodical installment is known as hire purchasing. Leasing is governed by Accounting Standard 19, whereas there is no specific accounting standard for the hire purchasing. Down payment is a must in case of hire purchasing, but in case of leasing, it is not. Down payment is not a must option. The duration of leasing is longer than the hire purchasing. Leasing may cover assets like land and building, plant and machinery, etc. Conversely, cars, trucks, tempos, vans, etc. are the kind of assets which are sold on hire purchasing. In contrast to leasing, in which lessee has to pay the cost of using the asset only, the installment paid in hire purchasing includes the principal amount as well as the interest for the asset. In hire purchasing, the ownership is transferred to the hirer only if he pays all the outstanding installments. On the other hand, in a finance lease or leasing agreement, the lessee gets the option to buy the asset at the end of the term by paying a nominal amount. But in operating lease, there is no such option available to the lessee. So this was all about leasing and lease agreement. Thank you.